Hey everyone, and thanks for tuning in. I'm an analyst for Talk Tickers, and today we're digging into the biggest shakeup to the US stock market we've seen since 2005. This was all kicked off with a huge surge in retail trading and, moments like the whole GameStop saga that really showed the cracks in the system.
So, let's start with something we all know: zero commission trading. In just a few years, it's opened up the markets to millions of new people. But, as we're about to see, nothing is ever really free.
You see, this move to free trades completely flipped the script on how brokers make money. And more importantly, it changed how your trades get executed. This has brought up some really tough questions about hidden costs, conflicts of interest, and what good execution even means anymore.
Okay, so here's our game plan. We'll look at what started all this. Then, we'll dive into the engine that powers free trading. We'll uncover a major flaw in the system that this exposed, check out the SEC's massive response, and finally, figure out what this new world of transparency really means for you.
Right, so the boom in retail trading, which, let's be honest, hit a fever pitch with GameStop, it basically yanked back the curtain on the market's old, creaky plumbing, forcing regulators to pay attention.
And don't just take my word for it, SEC Chair Gary Gensler said it himself. It became crystal clear that the old rules, written for a totally different era, just weren't cut out for today's super-fast, retail-heavy electronic market.
And look at this shift. It's pretty wild. By 2023, almost half of all stock trading wasn't even happening on public exchanges like the NYSE or NASDAQ. Instead, it was being done in the so-called dark markets, mostly handled by a handful of giant wholesale firms.
So, this begs the question: if we're not paying commissions, how are our brokers staying in business? Well, for a lot of them, the answer is a pretty controversial practice called payment for order flow.
Here's how it works. Big wholesale firms like Citadel Securities and Virtue pay retail brokers like Robinhood for the right to handle their customers' trades. The wholesalers then make their money on the tiny price difference between buying and selling a stock. That's the bid-ask spread.
And we're not talking about pocket change here. In 2021 alone, just the 12 biggest U.S. brokers raked in a combined $3.8 billion from POFF. It's literally the engine that keeps the commission-free model running.
Now, this is where the big debate is. On one side, wholesalers and brokers say, hey, this is great. It gives you zero commissions, and we often get you a slightly better price. But on the other side, critics are saying, hang on, this creates a massive conflict of interest. A broker might be tempted to send your order not to the place with the absolute best price, but to the wholesaler who pays them the most.
But the retail boom didn't just put a spotlight on PFOF. It also exposed a much older, deeper problem with how the market is built: the fact that it basically ignores small orders.
Get this. The official definition of a round lot has been 100 shares for over 120 years. We're talking post-Civil War era. It's an idea from a time of guys yelling on trading floors, totally out of step with the world of high-priced stocks and trading on your phone.
And here's why that really matters. Because of that ancient definition, most of our trades, the ones for less than 100 shares, were pretty much invisible. They didn't have to be included in the main reports on execution quality, called Rule 605. Their prices didn't even count towards the official best price in the market. It created this huge blind spot where nobody could really see how well retail orders were being treated.
So, faced with the GameStop aftermath and all these deep-rooted issues, the SEC kicked off its biggest overhaul of the market in almost 20 years, trying to drag the rules into the 21st century.
You can see a pretty clear path here. The old rules were from 2005. The market chaos of 2021 was the wake-up call. And by 2024, the SEC rolled out a whole new set of rules to fix things.
At the heart of all this is a huge update to that Rule 605. Before, only the trading venues had to report, and only on big round lot orders. Now, the big brokers have to report too, and they have to include everything: odd lots, fractional shares, you name it. They also have to use way more advanced metrics and, this is key, provide a summary report that a normal person can actually read.
And it wasn't just about reports. The SEC changed the market's plumbing. That 120-year-old round lot rule, gone. It's now replaced with a modern system based on a stock's price. This means way more quotes now count toward the best price. They also allowed for more precise pricing, down to half pennies for a lot of stocks.
Okay, so these new rules are rolling out. But the million-dollar question is, what's actually going to change? What's the real-world impact for all of us? Well, for starters, they're going to shine a massive spotlight on a market that's super concentrated. Back in 2022, just 3 of these wholesalers handled over 80% of all marketable retail orders. With public data now available for each broker, the scrutiny on these firms is about to go way, way up.
So you've got 2 schools of thought here. The bull case is that all this new data will let us shop around for the broker with the best execution quality, forcing everyone to compete harder. The SEC thinks this could save us $1.5 billion a year. But the bear case says, hold on, will people actually read these complicated reports? And is just being transparent enough to really make brokers change how they do business?
All of this, all the rules, the data, the debates, it really all boils down to one single core issue for every single one of us investing in the market today.
And that's the question right there. Whether these new rules actually work or not, well, it all comes down to this.
At the end of the day, the power from this huge regulatory change is now shifting away from the regulators and onto us, the investors. The data's going to be there, but accountability only happens if we actually use it.
Thanks for joining this Talk Tickers analysis. And just as a reminder, this is not financial advice.